This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Party like it's 1999. All three major stock indexes close at all-time highs on the same day for the first time in 17 years.
New reality. Macy's shuts 100 stores as fewer people head to the malls and more people shop online. But what took it so long to make the move?
Hot market. Tech startups are not just about young millennials. A growing number see a big opportunity by targeting boomers. Those stories and more tonight on Nightly Business Report for Thursday, August 11th.
Good evening, everyone, and welcome. It is hot outside and even hotter on Wall Street. Not one, not two, but all three of the major indexes we follow for you here on NBR closed at records today, something that hadn't happened simultaneously since 1999. Back then, technology played a big role in driving the markets. Today, it was a combination of factors that boosted investor sentiment. Higher oil prices, strong earnings from department stores, and positive news on the jobs market. Let's get right to those record-breaking numbers. The Dow Jones Industrial Average added 117 points to a record 18,613. Nasdaq up 23 to a record 5228, and the S&P 500, I'll say it again, gaining 10, a record 2185. As for domestic crude, it settled up more than 4% on comments from the Saudi oil minister about possible action to stabilize prices. Bob Pisani at the New York Stock Exchange has more now on what drove stocks to historic highs today.
How did we get to new record highs? We did it the old-fashioned way. We rotated into it. For most of the year, investors chased anything that paid a dividend, telecom and utilities and consumer staples and REITs. But since the start of the third quarter, there's been a rotation. These names are now out of favor. Tech has been the new leadership due to stellar earnings from the likes of Microsoft and others. But the rally has been even broader than just technology. For example, big global industrial names like Illinois Toolworks, United Technologies, Dover, and Eaton have powered to new highs in the last 6 weeks. And in the last couple of weeks, energy stocks have become a new leadership group as oil stopped its slide and has stabilized around $42. Now, for everybody wondering why we keep holding up, there's several reasons. First, the U.S. economy, while choppy, is still among the best in the world. We also see second half earnings that are relatively stable. Next, crude oil, which gave everyone a scare a week ago, is stable around $42. Third, there's a lot more talk of fiscal stimulus, not just monetary stimulus, in Japan, the UK, Europe, even the US. Finally, it's a cliche, but Tina, there is no alternative to stocks, is a very real phenomenon. There's no yield in bonds, there's no gains in cash. All this means stay in stocks. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And speaking of stocks, retail stocks were bolstered by a surprise announcement from Macy's. The world's largest department store is shuttering a handful of its stores to keep pace with the dramatic changes happening in that sector. Today, Macy's also reported earnings and revenue that topped expectations, and it reiterated its full-year profit and sales guidance. Its comparable sales drop wasn't as bad as feared, and sales improved each month of the quarter. Investors liked that report and Macy's long-term plan as well. As a result, shares soared 17%, making it the best-performing stock on the S&P 500. Courtney Reagan has more on Macy's new direction.
Is the magic of Macy's back, or is it just adjusting to a new reality? Macy's second quarter profit and sales turned out better than expected, though still below last year. But CEO Terry Lundgren says the company is not one to sit still as shoppers increasingly go online. The retailer is closing about 100 of its more than 700 stores by early next year, most of which are cash flow positive, but showing signs of declining profitability. This will allow Macy's to focus on its strongest performing locations. Wall Street applauds the aggressive moves, saying there were simply too many stores.
This is absolutely the right decision. E-commerce continues to grow. Brick and mortar continues to be constrained. And I think the brands, over the last couple of weeks have really played a part in this. They're pulling back on their promotional activity. And I think Macy's is making this decision today. It's the right decision. They're getting back to a stronger, leaner store base that has best-in-class brands, and I think it's their way of competing with Amazon and the off-price sector.
Macy's is also considering alternatives to extract shareholder value from its real estate for 4 of its large city flagship stores, as well as its San Francisco men's store. For the remaining stores, Macy's says it's investing to make them better for shoppers by increasing vendor shops, adding technology upgrades, and beefing up staff for services like personal styling. The retailer continues to invest in its online operations as well. While Lundgren thinks more seasonable temperatures and less drastic drops in tourist spending are helping retail right now, he also thinks it's time for consumer spending to swing back to more discretionary goods like clothing.
The consumer's been spending. They've just been buying automobiles, and they've been buying home improvement. They've been paying for medical expenses, and they're paying all these things that are not sold by me. And so, but I think this is good news because they don't need another car now. We've had record sales of cars. They don't need another car. They don't need to fix their home anymore. They did that, right? Home Depot's been awesome. So it's my turn. It's our turn.
If Lundgren is right, it could mark the end of a year-long downturn for department stores. For Nightly Business Report, I'm Courtney Reagan.
Macy's did well, but shares of mall operators did not do so well on news that Macy's planned to cut 100 stores. The nation's largest mall operator, Simon Property Group, fell along with General Growth, Macerich, and Kimco Realty.
Kohl's also reported a strong quarter and contributed to today's broader stock market optimism. The big box retailer beat both earnings and revenue estimates for the second quarter. Gross margins expanded as the retailer cleared out excess inventory. But Kohl's cut its earnings forecast for the year and reported a slightly steeper drop than expected in same-store sales. Investors remain focused on the better-than-expected earnings and sent shares 16% higher.
So has retail finally started to figure out what has been ailing it for so long? A quick fix. Sucharita Moparu covers the retail sector for Forrester Research. Sucharita, welcome. Is it as simple as, hey, close stores and everything will get better for the big chain companies like a Macy's, like a Gap, like a Best Buy?
Sure. Well, the issue is that many of these stores, especially these large chains, are very overstored. In the U.S., we have about 25 square feet of retail per capita, and that's about 10 times higher than it is in Europe. So we just have way too many stores, and I think that the street knows that a lot of these big retailers have too many stores. Now, is that the only thing they need to do? Of course not. They need to invest in their .com channel. They need to invest in alternative distribution. They need to look at other ways to diversify and grow their businesses in addition to closing the stores that just aren't working that well.
It sounds simple to say they're going to close stores, but it sometimes isn't that simple, especially if they don't own the underlying real estate, correct?
Exactly, and I think that that's really part of the reason that some of the mall operators are being challenged today, because these are leases that have helped them historically, because particularly the department stores will have leases that are decades long, and that's sort of the trade-off for getting good terms on the lease in the first place. And that's part of the issue with a lot of the department stores, is that you can't simply just flip the switch and close stores when sales are down. You have to wait out the end of your lease. And that's not just an issue with department stores. That also applies to big box as well.
So we looked just the item right before we introduced you was about some of the mall operator stocks, and they didn't do well today. What you're describing to me in this overstored environment looks like a coming debacle for mall operators, the people who own the strip malls and so forth. What's going to happen to them?
Well, there is no question that there is a coming shakeout in retail, and there has been no shortage of people who've been predicting this shakeout for a long time. Like I said, there are 10 times as many stores in the U.S. per cap as in markets like Europe, and what that means is that we just have too many stores, and so your options are to close those stores, redevelop a lot of that real estate into other types of things. Like we see that already happening, where real estate is becoming redeveloped into dental offices or schools. Look
out below. Sucharita, thanks very much. Sucharita Moparu with Forrester Research. Thanks.
More positive news on the job market. The number of Americans filing for unemployment benefits fell last week. Initial jobless claims declined by 1,000 to a seasonally adjusted 266,000. Claims have been below the key 300,000 level for 75 consecutive weeks, the longest streak since 1973.
The price of goods shipped to the U.S. from abroad rose slightly in July. Import prices, which measure what U.S. companies pay for things like South Korean cars, Middle Eastern oil, gained 0.1% last month. Import prices are looked at closely for any sign that inflation might be in the pipeline.
When it comes to the economy, Hillary Clinton and Donald Trump are taking off their gloves. Both are laying out their agendas, and both are on the attack. John Harwood has more on the war of words from Washington for us. Hi, John.
Well, Sue, they are taking off the gloves, but it's interesting. When you look at the two speeches they made this week, there is some overlap in their positions. Hillary Clinton went to Michigan today, said she too, like Donald Trump, is against the Trans-Pacific Partnership, except that she said her view is that well-structured trade deals can work and America can compete, and Trump is much more pessimistic.
Normally you would say you want to reduce your debt, and I like to reduce debt too, as much as anybody. The problem is you have a military problem, you have an infrastructure problem, a tremendous infrastructure problem, and you have other problems. What's going to happen when the rates eventually will go up and you can't borrow? You absolutely can't borrow because it's too expensive. You'd be paying so little interest right now. This is the time to borrow.
Apologies, that was the different kind of overlap. That was Donald Trump talking about borrow and spend, which is usually associated with Democrats. Here's Hillary Clinton on the trade policy.
His approach is based on fear, not strength. Fear that we can't compete with the rest of the world, even when the rules are fair. Fear that our country has no choice but to hide behind walls. If Team USA was as fearful as Trump, Michael Phelps and Simone Biles would be cowering in the locker room.
So counting on the Olympic metaphor to carry her argument there, Sue.
John, you know, they do agree, as you mentioned, on a few things, but Donald Trump's critique of Hillary Clinton today, what was that about?
Well, it was a couple things. First of all, he says that she would raise taxes, that he would cut them. She's for Obamacare, which he says is a disaster, hurting jobs. He said her Senate record was bad. And he also repeated what he said over the last 24 hours, which is that she and President Obama were co-founders of ISIS, trying to discredit her more broadly.
All right, John. Thank you so much. John Harwood in Washington tonight.
Both candidates say that one way to fix the economy is to increase spending on our infrastructure and fix the nation's failing bridges, rails, and roads. But as Morgan Brennan reports, their plans differ in the details.
No matter who wins the American presidency, expect a big push for infrastructure spending. Both candidates have been criticizing the poor state of America's roads, bridges, railroads, and airports. Just today, Republican nominee Donald Trump proclaiming the nation's infrastructure is in, quote, the worst condition it's ever been in, likening certain airports to, quote, third world countries. Democratic candidate Hillary Clinton opining that, quote, we are living off the investments that were made by our parents' and grandparents' generations. So how would the opponents address this massive issue? Trump asserts he will spend, quote, a lot more than the $500 billion drummed up by Clinton, saying he will potentially take advantage of low interest rates to borrow and make it happen.
Basically, you're going out and you're borrowing money on the United States to rebuild your infrastructure. It would be infrastructure money. And maybe there's ways of giving additional, credits to people that buy these bonds. But, because frankly, the interest rate would be so low.
Such a strategy would represent a potential break with the official GOP platform, which prioritizes reducing the national budget deficit and curtailing spending. As for Clinton, she's offering a 5-year, $275 billion proposal, including $25 billion to be dedicated to a bank that would extend loans, loan guarantees, and bonds to raise an additional $225 billion in investments.
A big part of our plan will be unleashing the power of the private sector to create more jobs at higher pay. And that means for us creating an infrastructure bank to get private funds off the sidelines and complement our private investments. $25 billion in government seed funding could unlock more than $250 billion and really get our country moving on our infrastructure plans.
Clinton is also looking to build out a renewable energy grid and provide more broadband access as part of her infrastructure plan. For his part, Trump hasn't put forth a detailed policy on his website, at least not yet. Both candidates also promised to use domestic suppliers and manufacturers for the work. But proposals from the campaign trail are just that, since any plan would still need to clear Congress. For Nightly Business Report, I'm Morgan Brennan.
Still ahead, cashing out, why mutual fund investors are nervous about this market, even with stocks at record levels.
There's a lot of talk out there these days about the so-called millennials. Sure, they're now the largest demographic group, but only by a little, and they're not the richest. The baby boomers are. That's why more and more entrepreneurs are targeting the boomers. Didi Roy reports.
Have your client's hands on the shoulder. Grab underneath the belt, and you're going to count and say, "Ready, Gary? We're going to stand up together, okay?"
These individuals work for Honor, a company that connects seniors with caregivers who help elders live independently.
One thing we didn't talk about earlier is that you want to make sure that the belt buckle is in front. You don't want to have that in the back or the side. You want to make sure that the belt buckle is in the front.
Caregivers go through extensive training to become part of Honor's on-demand service, which users can tap into through its app. It's just one example of a tech startup courting baby boomers and seniors, a market that's grabbed the attention of investors and VCs.
This is a huge market, and as we think about healthcare, it is one of the biggest markets that actually spend healthcare dollars.
Lynn O'Keefe, a senior partner at Kleiner Perkins, says 1/3 of the firm's digital health portfolio companies target older adults because their numbers and spending power make them such a formidable economic force. Nearly 75.5 million boomers live in the U.S., according to U.S. Census data. The caregiving market alone is expected to reach $72 billion by 2020, according to the AARP. And the AARP says the annual economic activity of the 50-plus demographic is more than $7.5 trillion.
A baby boomer, in my opinion, is the most economically attractive to any company. They're also really brand loyal. This is what I love about them.
Marcy Rogo co-founded Stitch, a subscription-based service that helps boomers connect and find companions. The 2-year-old company has 50,000 paying members in 50 cities worldwide. While Rogo says older adults may not be as tech-savvy as millennials, she thinks they are more willing to pay for online services.
They also have far more disposable income, obviously, than any other generation. They've purchased their house and those big things. So if they're still working, they still have income coming in and very few expenses. So it's a great combination for a good group to serve.
The AARP tells us it's seeing increased interest from entrepreneurs, with more than 200 applicants to its startup demo day last year. That's more than double the number in 2012. And there's also a boost in venture capital money. Just this week, Honor raising $42 million in funding. For the Nightly Business Report, Aditi Roy, San Francisco.
To read more about startups targeting baby boomers, head to our website, nbr.com.
Profit tops expectations at Nordstrom, and that's where we begin tonight's market focus. The apparel retailer said its annual anniversary sale helped lift results. Revenue and same-store sales did fall in the quarter, but they were better than expected. The company also raised its earnings guidance for the year. Shares were sharply higher in initial after-hours trading after finishing the regular session up 7% to $47.55. U.S. officials are investigating Valeant again. According to the Wall Street Journal, the Justice Department is looking into whether the pharmaceutical company defrauded insurers by hiding its relationship with the pharmacy company Philidor. The investigation could result in criminal charges against Valeant and the former management at Philidor. Shares fell 10% to $24.49.
Alibaba reported higher than expected profit and revenue in the latest quarter. Results helped by growth in the e-commerce company's cloud computing business and a recent acquisition. Alibaba's executive vice chairman said sales were strong.
With the quarter that we just had, we generated $4.8 billion of revenue. That's 59% growth. It's the highest growth rate we've ever had since our time of the IPO.
Shares up 5% today to 91.77. Brinker International saw its profit and revenue rise as the restaurant company benefited from an addition of more than 100 new store locations. The results topped street expectations. The owner of the restaurant chain Chili's also gave upbeat guidance for the year. Shares popped 12% to 52.72.
Well, with stocks at record highs, a new report shows that investors have actually been funneling more of their cash into bond mutual funds, less into stock funds. With us now to talk more about this trend is ICI's chief economist, Brian Reed. Good to have you here, Brian. Welcome.
Thanks for having me on tonight, Sue. Thank you.
I was surprised by those results. Why the continued attraction of bond funds, given the fact that we're at record high in stocks?
I think part of the reason is that there are a lot of asset allocation models out there, such as target date funds or other types of strategies. And so we've had a pretty substantial run-up in the stock market, as you've pointed out, probably the first one in several years. And so what a lot of these programs will do will rebalance then away from stocks and into bonds to keep the ratios that they're targeting about the same.
So you're saying that this is more on autopilot than individuals making decisions. Which category are bond funds in terms of total return outperforming stock funds this year?
No, they're actually still underperforming somewhat. At least looking at February, that's where the low was in both both the stock market and where interest rates had peaked out. And since then, stocks have certainly outperformed. What's been attractive are areas such as investment-grade bond funds and muni bond funds, for that matter. And part of this, too, is some investors riding that wave as interest rates have fallen, bond prices have risen, and coming into those bond funds to take advantage of those rising bond prices.
So as we look at these markets at new record highs, does that sort of phenomenon tend to turn the tide with investors? You know, when they watch NBR at night and as they do every single night, I know, and we sit at these record highs, do they then take a look at their portfolio and say, you know what, maybe I shouldn't be sitting in a bond fund?
There always is some repositioning. Most investors, though, use a financial advisor or they're investing in something like a target date fund at their work through their 401k plan. And these financial advisors are working with their portfolios, and they do try to keep them in balance. But there are investors who are looking towards these falling interest rates, particularly with central banks in Europe lowering interest rates, pushing interest rates lower globally and bond prices higher. And I think there are investors who are moving in to take advantage of those potential capital gains.
The outflow from equity funds into bond funds or the flows into bond funds, it hasn't just happened suddenly. It's been going on for years. Have a whole generation of investors here from 2009 forward missed this bull market?
No, what's really going on here is that we've actually see investors holding as much equity as they did in 2009. But part of this is a demographic phenomenon. We have the baby boomers who are holding the bulk of the assets in these 401k plans and the assets generally moving into retirement. And as they do, they begin to reposition their portfolio to decrease their equity exposure and increase their bond exposure slightly. These aren't large moves, but when you have billions of dollars moving, this is what happens.
All right, Brian, thanks for clarifying everything for us. Brian Reed with ICI.
Coming up, why Rio de Janeiro is an attractive vacation destination, if you want to call it that, for people who want to come home with a brand new look. Brazil isn't just a hot spot for world-class athletes right now. There's another huge population of tourists in Rio de Janeiro who are looking for a little nip and tuck. Carl Quintanilla tells us why Rio is the hemisphere's happening place if you want to get some work done at a bargain price.
Brazil is known for its beautiful beaches and beautiful people with good reason. Brazil is second only to the United States in the number of cosmetic surgeries. And despite the country's recession, the Brazilian Society for Plastic Surgery says the number of surgeries has increased 10% each year since 2010. The industry gets a big boost from medical tourists who go to Brazil specifically to get cosmetic procedures at discount rates.
Here in Brazil, we're going to find prices around 30%, 50% less in the U.S. with the same quality of services.
Cosmetic Vacations caters to medical tourists in Rio. They work with 100 patients a year, mostly from the U.S. Company reps make doctor's appointments, arrange travel, and recommend restaurants. It's part medical consultant, part concierge service.
Before the surgery, they come and they save some days to do tourism, of course. They want to see Brazil.
Dr. Luis Geraldo, a surgeon in Copacabana with 40 years' experience, gets 10% of his referrals from Cosmetic Vacations. His specialty, performing multiple surgeries at once.
Composite body contouring. It's together, yes. Liposuction, fat graft, and abdominoplasty.
One stop shop.
And that's part of the appeal for patients who travel across the globe.
One thing, the doctors in the United States, they're kind of skeptical about doing all of those surgeries at one time.
Medical tourism to Brazil is expected to grow 45% over the next 5 years, an attractive figure to the industry and its patrons.
I do plan on going back to have some other things done.
For Nightly Business Report, I'm Carl Quintanilla in Rio.
Before we go, here's another look at the record close for the three major indexes. The Dow added 117 points, the Nasdaq rose 23, and the S&P 500 gained 10. And that does it for us on Nightly Business Report. Thanks for watching.
And thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we will see you back here tomorrow.